If you're serious about trading, stop scrolling right now, because what you're about to hear could be the difference between blowing your account and building real consistency. Most traders fail not because of strategy, but because they never understand what real discipline looks like. And today we're breaking that illusion wide open. Trading is execution, not prediction, and this is the first truth every serious trader must fully accept before they can expect any consistent success in the markets. Most beginners enter trading believing that the real skill lies in forecasting what the market will do next, as if it is a puzzle that can be solved with enough indicators, news analysis, or chart patterns. But in reality, even the most experienced traders in the world are wrong more often than they are right. What separates professionals from amateurs is not their ability to predict with perfect accuracy, but their ability to execute a well-defined plan without hesitation, even when uncertainty is at its highest. The market is not a place where certainty exists, it is a place where probabilities play out over time. Every single trade is just one event in a long sequence, and no single outcome defines success or failure. A professional trader understands that once a strategy has an edge, the real job begins at execution. This means entering trades exactly when the setup appears, placing stop losses without emotional resistance, and taking profits according to the plan rather than greed or fear. The moment a trader starts second-guessing execution, the entire system breaks down. For example, a perfect setup can appear on the chart, but hesitation causes a delayed entry, which changes the risk-reward ratio. Or a trader might enter correctly but move the stop loss farther away because they feel the market will reverse. These small emotional decisions destroy long-term consistency more than any losing streak ever could. This is why traders like Tom Hougaard often emphasize discipline over intelligence. Intelligence may help you understand the market, but discipline is what allows you to survive in it. Execution is about following rules even when your emotions are screaming the opposite. It is about trusting the system you have tested even after a series of losses and continuing to behave the same way when a winning streak creates overconfidence. Execution is mechanical, while prediction is emotional. The more you focus on prediction, the more emotionally involved you become with each trade, and the more likely you are to deviate from your plan. Another critical aspect of execution is accepting uncertainty. Many traders fail because they want confirmation before acting. They wait for extra signals, more confirmation candles, or perfect alignment of indicators. But by the time everything feels safe, the opportunity is often gone or the risk-reward has deteriorated. Professionals know that uncertainty is not a problem to be solved, it is a condition to be managed. They enter trades knowing they might lose, but also knowing that over a series of trades their edge will play out. Execution means acting without needing certainty. Over time, execution builds consistency. Not because every trade is a winner, but because the process is repeated accurately enough times for probability to work in your favor. A trader who executes flawlessly with a 40% win rate can still be profitable if risk management is correct. Meanwhile, a trader who predicts correctly 60% of the time but executes poorly can still lose money. This is the paradox that destroys most beginners. They focus on being right instead of being disciplined. Ultimately, trading is a performance skill, not a guessing game. The chart is not asking for your opinion, it is demanding your discipline. Every click of the buy or sell button is a test of whether you can follow your own rules under pressure. And the sooner you understand that execution is everything, the sooner you step into the mindset of a professional trader instead of a hopeful gambler trying to predict the future. Most traders enter the market believing that the secret to success lies in finding the perfect strategy. They spend months, sometimes years, searching for the best indicator, the most accurate signal, or the most profitable trading system. They backtest endlessly, watch tutorials, and copy setups from professionals, thinking that once they discover the right method, profits will naturally follow. But the uncomfortable truth is that strategy is only a small piece of the puzzle. The real battlefield in trading is not the chart, it is the mind. Psychology is more important than strategy because even the best system becomes useless in the hands of a trader who cannot control fear, greed, impatience, and self-doubt. Every trading decision is influenced by emotion. When a trade is open, fear immediately enters the picture. Fear of losing money makes traders close positions too early, even when their strategy is still valid. Fear also causes hesitation, leading to missed entries and broken discipline. On the other side, greed takes over after a few wins. A trader starts increasing position size without proper analysis, overtrading in hopes of multiplying profits quickly. Then there is revenge trading, the emotional reaction after a loss where a trader tries to win back money immediately, abandoning all rules and logic. These emotional reactions are not strategy problems, they are psychology problems. This is why two traders can use the exact same system and achieve completely different results. One trader remains calm, follows the rules, accepts losses, and waits patiently for the next setup. The other panics, interferes with trades, and constantly doubts the system. The difference is not technical knowledge, it is mental discipline. Trading exposes personality flaws very quickly. It reveals impatience, insecurity, and the need for control. And until a trader learns to manage these internal weaknesses, no strategy in the world will save them. Even professional traders understand that psychology determines long-term success. A system only provides an edge, but execution depends entirely on mental strength. Traders like Tom Hougaard often emphasize that staying disciplined under pressure is far more important than predicting market direction. Because when money is on the line, the brain behaves differently. Logical thinking gets replaced by emotional reactions. A trader might have a clear plan before entering the market, but once the trade goes into profit or loss, emotions distort decision-making. This is where most mistakes happen, not in analysis, but in execution under emotional stress. Psychology also affects consistency. Many traders can follow their rules for a few days or even weeks, but struggle to maintain discipline over time. They become overconfident after winning streaks and overly cautious after losses. This emotional cycle creates inconsistency, which destroys long-term profitability. A strong trading psychology allows a trader to stay balanced regardless of recent outcomes. A loss does not create panic, and a win does not create arrogance. Every trade is treated as just one event in a long series, not as a reflection of personal worth or skill. Another important aspect of trading psychology is acceptance. Accepting that losses are part of the game is one of the hardest lessons for traders. Most people naturally want to avoid loss at all costs, but in trading, losses are unavoidable. A strong mindset does not try to eliminate losses, it manages them. It understands that even with a strong edge, uncertainty will always exist. Instead of reacting emotionally to losses, disciplined traders focus on executing the next trade correctly. In the end, psychology is what allows a trader to actually use their strategy effectively. Without emotional control, even the most advanced system collapses under pressure. With strong psychology, even a simple strategy can become profitable over time. Trading is not just about reading charts, it is about mastering yourself. And the traders who realize this early are the ones who survive, adapt, and eventually succeed in the long run. Discipline under pressure defines a trader more than any strategy, indicator, or market knowledge ever will. In trading, everything looks easy when the market is calm, when charts are moving slowly, and when decisions can be made without urgency. But real trading does not happen in calm conditions. It happens in moments of speed, uncertainty, and emotional stress. It happens when price is moving against your position, when profits are flashing on the screen and disappearing just as quickly, and when every second feels like a test of your judgment. In those moments, discipline is not just important, it is everything. Most traders believe they are disciplined until pressure reveals the truth. It is easy to follow a trading plan when there is no money on the line or when the trade is moving in your favor. But the real challenge begins when uncertainty enters the picture. A trader enters a position with a clear stop loss and take profit level, but as soon as the market moves slightly against them, fear starts whispering. The mind begins to question the plan. What if it goes further against me? Should I close early? Maybe I should move the stop loss a little wider. These thoughts seem harmless, but they are the beginning of discipline breakdown. Pressure exposes emotional weakness. When a trader sees profit, greed becomes active. They start thinking the market will continue forever in their favor, and they forget the exit plan. Instead of sticking to a structured approach, they delay decisions, hoping for more profit. On the other hand, when the trade goes into loss, fear takes control. The trader abandons logic and starts reacting emotionally instead of following rules. This cycle of fear and greed is what destroys accounts, not the market itself. Discipline under pressure means following your plan even when your emotions are screaming for something different. It means accepting discomfort as part of execution. A disciplined trader understands that every trade will not feel comfortable. In fact, most good trades will feel uncomfortable at the time of execution because uncertainty is always present. The difference is that disciplined traders act according to their system, not according to how they feel in the moment. This is where the mindset of professionals becomes very different from beginners. Beginners want to feel confident before acting, while professionals act despite uncertainty. They know that confidence comes after execution, not before it. They also understand that pressure is not a signal to change behavior, it is a test of whether their behavior is correct. If a trader starts changing rules every time pressure increases, then the system has no value, consistency disappears, and trading becomes random. Traders like Tom Hougaard often highlight that real success in trading comes from doing the hard things repeatedly, especially when it feels uncomfortable. Anyone can follow rules when everything is going well, but very few can follow rules when money is moving fast and emotions are high. That is why discipline is considered the true edge in trading. It is not just about having a strategy with positive expectancy, it is about being able to execute that strategy under stress without deviation. Another key part of discipline under pressure is emotional awareness. A disciplined trader does not eliminate emotions, they recognize them but do not act on them impulsively. They notice fear but still hold the position according to plan. They notice greed but still take profit where the system dictates. This ability to observe emotions without being controlled by them is what creates consistency over time. Pressure will always exist in trading. The market is designed in a way that constantly challenges patience and emotional control. It rewards those who can stay steady and punishes those who react impulsively. That is why discipline is not a one-time decision, it is a repeated choice made in every single trade. In the end, discipline under pressure is what separates survival from failure. Many traders can analyze charts, many can build strategies, but very few can execute those strategies consistently when emotions are high. And in trading, it is not what you know that matters most, but what you can actually do when everything is on the line. Consistency in trading does not come from excitement, motivation, or bursts of inspiration. It comes from process, boring, repetitive, structured actions done the same way over and over again, regardless of how you feel in the moment or what the market is doing. Most traders misunderstand this completely. They believe that to become consistent, they need to find more excitement in trading, more confidence in setups, or more emotional highs from winning trades. But in reality, excitement is one of the biggest enemies of consistency because it leads to overtrading, impulsive decisions, and deviation from a proven system. When a trader first starts, trading feels exciting. Every candle movement looks like an opportunity. Every breakout feels like a chance to make quick money. This excitement creates energy, but it also creates chaos. Traders jump from one strategy to another, constantly changing rules because they are chasing excitement instead of structure. One day they follow indicators, the next day they rely on price action, and the day after that they switch to someone else's method they saw online. This lack of stability prevents any real evaluation of performance because the process is never consistent long enough to measure results properly. A professional trader understands that consistency is not about how many winning trades you have in a week or a month. It is about how faithfully you follow your process over a long period of time. The process includes entry rules, risk management, position sizing, stop-loss placement, and exit strategy. When these elements are clearly defined, the trader's job becomes simple. Execute the process exactly the same way every time, without emotional interference. Whether the previous trade was a win or a loss does not matter. What matters is whether the process was followed correctly. The danger of excitement is that it creates emotional decision-making. After a winning trade, excitement makes a trader feel invincible. They start increasing position sizes, entering trades without proper setups, or ignoring risk rules because they feel in the zone. This is where consistency breaks. On the other hand, after a losing streak, excitement turns into frustration. The trader feels the need to recover losses quickly, leading to revenge trading. In both cases, the problem is not the strategy, it is emotional reaction replacing structured process. True consistency is built in moments where nothing exciting is happening. It is built when the trader takes a setup that looks average, follows the rules exactly, and accepts the outcome without emotional reaction. It is built when a trader skips a trade because the setup does not meet criteria, even though they feel like trading. It is built when losses are accepted calmly because they are part of the system, not a disruption to it. These moments may feel boring, but they are the foundation of long-term success. Traders like Tom Hougaard often emphasize that professional trading is not about excitement or constant action, but about discipline and repetition. The professionals are not looking for thrill, they are looking for execution quality. They understand that the market rewards structure, not emotion. Over time, it is the repetition of correct actions, not emotional intensity, that produces consistent results. Another important aspect of process-driven trading is that it removes decision fatigue. When everything is based on rules, the trader does not need to constantly guess or interpret what to do next. The process tells them when to enter, when to exit, and how much to risk. This reduces stress and improves clarity. Instead of reacting to every market movement emotionally, the trader simply follows a predefined system. This is what creates stability over time. Excitement is temporary, but process is permanent. Excitement fades after wins and intensifies after losses, but process remains constant regardless of outcome. This is why consistency cannot be built on emotions. It must be built on structure that does not change with mood or market conditions. Once a trader fully commits to their process, results may still fluctuate in the short term, but over time the edge of the system begins to show. In the end, consistency is not something you chase, it is something that naturally emerges when discipline meets repetition. When a trader stops trying to make trading exciting and instead focuses on making it repeatable, stable, and rule-based, that is when real progress begins. Because in trading, excitement may entertain you, but process is what pays you. Losses are part of the business, not failure, and this is one of the most important mindset shifts every trader must accept if they want to survive and succeed in the markets. Most beginners enter trading with a deeply emotional relationship with losses. They see a losing trade as something wrong, something broken, or something that needs to be immediately fixed. They believe that if they are losing, it means they are not skilled enough, not smart enough, or not disciplined enough. This thinking creates fear around losses, and that fear becomes the biggest obstacle to long-term consistency. In reality, losses are not only normal in trading, they are unavoidable. No strategy in the world can eliminate losses completely. Even the best professional traders in the world lose trades regularly. The difference is not in avoiding losses, but in how they respond to them. A professional trader understands that losses are simply the cost of doing business in the financial markets. Just like a shop owner must spend money to buy inventory before making profit, a trader must accept small, controlled losses in order to access larger opportunities over time. The problem begins when traders treat every loss emotionally. After a losing trade, they often start doubting their strategy. They question whether it still works, whether they should change something, or whether the market is against them. This emotional reaction leads to inconsistency. Some traders even abandon perfectly good systems after a few losses, not realizing that every strategy experiences losing streaks. The issue is not the system, it is the trader's inability to tolerate normal variance. Professional traders think differently. They measure success over a series of trades, not individual outcomes. One trade means nothing on its own, it is just one data point in a long sequence. What matters is whether the trader followed their plan correctly, not whether the trade won or lost. If the rules were followed and the risk was controlled, then even a losing trade is considered a good trade. This mindset removes emotional pressure from outcomes and shifts focus to execution quality. This is a concept strongly emphasized by traders like Tom Hougaard, who often highlights that survival in trading depends on accepting losses as part of the game. The market does not reward those who avoid losses, it rewards those who manage them properly. Losses are not a sign of weakness, they are a sign that risk is functioning correctly. Without losses, there is no risk, and without risk, there is no reward. Every profitable trader has already accepted this reality. When traders fear losses, they start making irrational decisions. They move stop losses further away to avoid being wrong. They exit winning trades too early just to secure profit. They hesitate to enter valid setups because they are afraid of losing again. All of these behaviors come from one root problem: emotional resistance to loss. Instead of treating losses as part of the system, they treat them as personal failure. This emotional burden destroys long-term performance more than any market condition ever could. A mature trader, however, separates identity from outcomes. A loss does not mean they are a bad trader. A win does not mean they are a great trader. They understand that the market is random in the short term but structured in the long term. This allows them to stay calm during losing streaks and avoid overconfidence during winning streaks. Emotional stability becomes their real edge. Another important aspect is risk management. Accepting losses is only possible when each loss is controlled. Professional traders always define risk before entering a trade. They know exactly how much they are willing to lose, and they accept that outcome before the trade even begins. This removes uncertainty from the emotional side of trading. Once the risk is defined, the only job left is execution, not worrying. Over time, traders who accept losses develop resilience. They stop reacting emotionally and start responding logically. A loss no longer creates panic, it creates feedback. It becomes information rather than identity. This shift allows them to stay in the game long enough for their edge to play out. In the end, losses are not the enemy of a trader. Emotional reaction to losses is. The market will always produce wins and losses, but only disciplined traders understand how to treat both with neutrality. Once a trader truly accepts that losses are simply part of the business, they stop fighting the market and start focusing on execution, consistency, and long-term growth. And that is where real success in trading begins.